If you ask 10 investors how their fund manager is performing, most will give you a number, but very few can answer a more important question. Was that return worth the risk being taken to achieve it? Most investors receive regular performance reports. They see percentages, charts, and commentary about markets. But performance numbers on their own can be misleading. A fund can produce strong returns simply because it took more risk than the market. And professional investors understand this. And that's why they spend a lot of time analysing what is called risk-adjusted returns. In other words, not just the return, but the risk taken to achieve it. The interesting thing is that private investors rarely ask those questions. Not because they lack intelligence, usually because the system is not designed to encourage curiosity. Reports are there to reassure, numbers look impressive, and over time, many investors simply assume everything is working as it should. But the most thoughtful investors tend to behave differently. They ask simple questions. How is risk being managed? What would happen if markets fall sharply? What exactly am I paying for? Sometimes the most valuable step is simply having space to think through those decisions properly. Not necessary to change anything immediately, just to understand the decisions more clearly. So if you're facing questions about your investments and would like to talk them through calmly before committing to advice, you can book a short introductory conversation.